Hi everyone, welcome to another edition of Joe's Finance Fundamentals. Today I'm going to talk about my top 10 tax saving tips. We're in the tax return season, so hopefully you've taken advantage of some of these, and if not, maybe you can put some in place for next season. First of all, a disclaimer, this information is intended only to provide general education for informational purposes only. The content does not provide financial, tax, legal, or any professional advice. Personal financial decisions should not be implemented based on the content of this channel. Do not act upon any of this information without first consulting a licensed investment, tax, or legal professional. Okay, top 10 tax savings tips. Here we go. First of all, do your own taxes. Our tax code is very complicated. I'm the first one to admit that. But I've always done my own taxes, even owning a small business. And have found that software like TurboTax is what I use. It actually makes it pretty easy. Do my federal and state taxes with TurboTax. So if I can do it, I think you can do it as well. Second one is a little bit counterintuitive. Try not to get a big tax refund. If you are one of those folks, and you know who you are, that you're really excited to get a big tax refund each year, you're only giving the IRS extra money throughout the year that you then get back, 6 to 12 months later. So it's your money. Instead, you want to adjust your federal withholding, and there's information out there. I think it's called a W-2 form on how to do that, what numbers to use in terms of your deductions. And you'll get more in your paycheck every week or every month, how often you get paid. And you can redeploy that hopefully into savings or 401k or an IRA or building your emergency fund or what have you. So actually try not to get a big tax refund. Contribute to your IRA early in the year. And you could wait till the last minute, so you can even contribute to your 2023 IRA up until I think April of 2024. That's called, I've heard it termed the procrastination penalty. So contributing early in the year to your IRA for that year gives it more time to grow. And also a traditional IRA is tax deductible for most people, so hopefully you have an IRA. Contributing to your 401k to at least get the company match is number 4. Traditional 401k contributions are pre-tax and lower your taxable income. Of course, for both of these, the IRA and 401k, there's Roth equivalents, and there's also, upper limits, annual limits as to what you can do. There's also an annual limit as to what you can do on a health savings account, but contributing to one, if you have a high deductible health plan, is one of the best things you can do. It's triple tax free. It's the only investment that I know of where the contributions are tax deductible up to the annual limit. The money grows tax free, and qualified withdrawals are tax free. So, by my way of thinking, that means you never need to pay taxes on that money that's contributed to an HSA, health savings account. Number 6, look to potentially sell money-losing investments to offset capital gains, and or you can deduct up to $3,000 a year in losses from your income on your tax return. That's sometimes you may hear it called tax loss harvesting, as that's what that means. Along those lines, if you sell a stock or a mutual fund for a profit after holding it less than 1 year, that's called a short-term gain. And you'll pay a higher tax rate than if you held it for more than 1 year, which is called a long-term capital gain. In fact, for 2024, there's actually 0% long-term capital gains tax rate applied to single filers earning less than $47,025 and married couples filing jointly with incomes of less than $94,050. So if you're less than those limits there, and you have a long-term capital gain, you would get a 0% long-term capital gains tax rate. Number 8, earnings in 529 plans, that's the education savings plan, can be withdrawn federally tax-free for qualified education expenses, including up to $10,000 per year for K through 12 tuition. Now, contributions to 529 plans are not tax deductible on your federal return. They may be on your state return. So 529s, while most commonly used for college savings, can also be used for K through 12 tuition. Now, these last two I've never personally used, and number 10 you'll see why, but number 9, I just found this out recently. There are actually lower mortgage rates set monthly by the IRS called applicable family rates, AFR. For March 2024, it's 4.4% versus conventional mortgages in the 6 to 7% range. Now, this is only applicable when a family member buys a house for another family member. So you basically are providing the mortgage. For example, if a parent would provide the mortgage for a child to buy the house. And, there's certain rules and regulations you must follow there. Keep track of this. Record keeping is important. But you would get a lower mortgage rate via this applicable family rate. And last but not least, if you gift someone stock or mutual fund shares, they take on your cost basis. Now, if this is something you've had for decades, that could be very significant. However, if you pass the same stock or mutual fund to them after your death, the cost basis is the same as the market value at the time of your death. So whatever that price was at the time of your death, that becomes the new cost basis for the person receiving the security. And that could be a significant tax savings to the receiver. Okay, so those are my top 10. Let me hear what some of the other ones that you might have. So please leave me some comments about what you think on this video. Like it, hopefully, and sub it up. Thanks. Talk to you later. Bye-bye.